Hi, everyone. Thanks for joining us today for our webinar, Carbon Credits, Defining the Energy Transition. My name is Kyle Harrison, and I'm the Head of Sustainability Research at Bloomberg NEF, which is the market research subsidiary of Bloomberg. And today, I'm joined by Paula Van Langenham, who is the Global Head of Carbon Markets at S&P Global Platts, as well as my colleague at Bloomberg, Zef Lokhandwala, who is an energy market specialist. And today, of course, we're going to talk about so many exciting things that are happening in the carbon markets. So excitement for voluntary carbon markets is at an all-time high. You've got demand and supply skyrocketing. And as a result, you could see increases in prices in the coming years. In compliance markets around the world, you're seeing increases in the cost of carbon. So for example, in the EU ETS, carbon prices just rose above $90 per ton. And then, of course, you have all these discussions around things like a global carbon market with Article 6 that just happened with COP26 a few weeks ago. So there's a lot of excitement today. We're going to talk about all these different trends, and again, with a specific focus on the voluntary carbon markets. Before I kick things off, just to give you guys a better idea of the run of show, I'm going to give you all a quick intro on why we should care about this topic today and what's so exciting about it. And then we're going to have some fabulous presentations by both Paula and Zef. And then we're going to go into some Q&A. So if anyone has any questions, feel free to please post them in the Q&A section, and we'll make sure to get to them during the Q&A section at the end of the chat. So without further ado, let's talk a little bit more about why we care so much about this today. So at Bloomberg NEF, one of the things that we're doing in our research is looking at all the leading corporate sustainability commitments. And one of the greatest indicators of all the companies that are getting involved in the sustainability world is companies that are going out and setting net zero targets or equivalent. And what this means is they are pledging at some point in time to effectively offset or neutralize or remove more than they emit on an annual basis. And the perfect petri dish for how effective and how much this is taking place is if you look at the focus companies for the Climate Action 100 Plus. So the Climate Action 100 Plus is a group of now over 600 investors and asset managers that are getting their heaviest emitting portfolio companies to decarbonize. And specifically, they're taking aim at what they call 167 of their focus companies. And these are deemed to be the heaviest emitting companies in the world. And what we found at Bloomberg NEF is that to date, roughly 120 of the 167 focus companies in the Climate Action 100 Plus have now set a net zero target or equivalent. If all these companies were to go ahead and achieve their net zero goals, it would result in them reducing or removing their emissions by 9.2 billion metric tons of carbon dioxide on an annual basis by 2050. So that's roughly a quarter of global CO2 emissions from 120 companies alone. And if these companies were to go ahead and purchase offsets for even a small portion of that total emissions, it would obviously create a massive, massive investment opportunity for traders, for banks, and of course for all these corporations that are trying to get involved in this carbon market. So really what we expect is this is a harbinger for a lot more demand in the offset market moving forward. And that's actually starting to manifest itself in activity that we can already see today. So you can see in 2021 through October, we've seen a record 127 million carbon offsets in the voluntary market retired by corporations. You can see a lot of those are coming from energy generation projects, but you're seeing something like a nature-based solution, like reforestation or avoided deforestation, is gradually taking a larger and larger market share in the carbon offset market. And I know Paula is going to talk a little bit more about the importance of nature-based solutions during her presentation today. But the question has always been, of course, there's so much demand. All these companies are going out and making these pledges, and they want to buy carbon offsets. But are suppliers actually starting to see that demand signal? Are they starting to react and actually ramp up supply? And year on year, carbon offsets have effectively doubled in supply every year since 2018. And you can see through October, we've seen a record 250 million voluntary carbon offsets issued from projects around the world. Of course, energy generation projects and nature-based solutions make up a huge portion of that supply, but you're also starting to see growing activity in sectors like energy demand. So, for example, distributing clean cook stoves in low-income communities around the world, and also things like emissions. So something like technology-based removals, like carbon capture and storage and direct air capture. And we're anticipating that there's going to be another doubling of supply next year as this market continues to grow and suppliers continue to see that demand signal. So of course, a lot of excitement in this market, but I think the question that you're all asking is, how can Platts and Bloomberg help you as this market goes ahead and develops? So I'm going to turn it over to Paula now to go through what they have on offering at Platts.
Great. Thank you all very much. My name is Paula Van Lanningham. I am the Global Head of Carbon at S&P Global Platts. I'm just going to talk a little bit about what we have been seeing in the voluntary carbon markets over the last year or so. It's been a very exciting year in the development of the voluntary carbon credit markets. But it's important to note that these are actually a lot older than people really think. This is something that comes with quite a lot of history and, by extension, quite a lot of baggage, which we are now in the process of sort of working around and evolving. And that's a big part of the conversation around COP26, and that's a big part of the conversation around corporate demand moving forward. They actually emerged in the early 2000s as a way to mitigate GHG emissions through consumer action. So they're a byproduct of the Kyoto Protocol. So they're much older than people really think. And there was a lot of interest in the voluntary carbon credit space in the early 2000s. However, like everything after the global financial crash of 2008, carbon markets largely kind of fell by the wayside. And that's where you saw the really sharp decrease in prices that has very much characterized the voluntary carbon markets up until about 2020, 2021, when we started to see these prices start to increase again. It also meant that there was really quite a degree of recognition within the voluntary carbon credit space for re-examining what essentially qualified as a good quality carbon credit and what qualified as a poor quality carbon credit. And this comes into sort of the understanding around what role sustainable development objectives will play in the development of different projects, as well as, of course, what ways these credits are actually claimed against certain types of emissions by different types of companies. So there's been a lot of evolution over the course of the last several years in particular in order to better define these terms, because it's become increasingly clear that the voluntary carbon markets are set to play an increasingly important role in the offsetting in the management of emissions moving forward. One of the challenges, of course, is that this has been a really big part of the conversation, specifically around COP26 and Article 6. And this is around the creation of essentially a global market that relies on a combination of voluntary and compliance-based projects. Exactly what role Article 6 is going to take within the voluntary carbon markets as they relate to corporate commitments has yet to be fully determined. Article 6 was the last article of the Paris Climate Agreement to be agreed. It was a big part of the conversations just last month in Glasgow. But there's still quite a lot of additional kind of development in order to determine exactly what this is going to look like. What it does mean is that there is going to be very much likely an increased relationship between the voluntary markets and the global markets around sort of the corresponding adjustment, and it's likely to have a pretty significant impact on the way these credits are going to trade moving forward. And we can talk about that in a little bit more detail as part of the question and answer session after the presentations. It's important to know that the voluntary carbon market itself looks very similar to the way that other markets look. So on one side, you have suppliers or project developers, and at the end of its life cycle, a carbon credit life cycle, you have the end users or the people who buy those credits and retire them against their emissions. In the middle, you have traders, brokers, retailers, etc. And the market itself is extremely transparent at the start of its life cycle and at the end of its life cycle, simply due to the creation of these registries which maintain which credits are available and have yet to be retired. The registries are maintained by a separate group which is unique to the voluntary carbon credit markets, and these are called the standards. There are quite a number of different standards that are out there. Platts currently reflects in our own voluntary carbon credit assessments, we reflect 5 of them. But there are more out there as well. But basically the standards are a big part of making sure that the market is actually, that the carbon credits do what they say they do. At the beginning of its life cycle, a credit is issued by a project developer, and it is made available in a registry that is maintained by a specific standard. And at the end of its life cycle, once it is retired, it becomes an offset and it is removed from that registry, which then prevents it from being used against different types of different emissions claims more than once. But one of the big challenges moving forward has been, how do you actually price something like this? There is an extremely wide variety of different prices depending on the type of carbon credit that you have. And that depends very heavily on whether or not you have what is essentially a reduction or an avoidance-based credit and a removals-based credit. Within those categories, you have different types of carbon credits that are either nature-based or tech-based. And all of these are sort of represent different types of projects with different sorts of attributes. This can have a pretty significant impact on the price of an individual carbon credit because certain buyers will look for certain attributes when looking to buy different carbon credits. So you can have a price that is as low as 30 cents per metric ton of carbon dioxide equivalent, or a price as high as $500 per metric ton of carbon dioxide equivalent. That level of variability within the types of voluntary carbon credits that are out there has created a challenge in finding a way to benchmark against those differences. One of the things that has become increasingly clear, however, is that there has been a sharp increase in voluntary carbon credit prices since the start of this year. Platts introduced its first voluntary carbon credit price at the start of 2021 in the Platts CEC, which reflects CORSIA eligible credits. The CORSIA program is the International Civil Aviation Organization's emissions management program. And over the period that we have been tracking this, the price has moved from 80 cents per metric ton of carbon dioxide equivalent on January 4th, all the way up to more than $8.50 per metric ton of carbon dioxide equivalent. And that has been really quite illustrative across different types of voluntary carbon credits. So in the graph here on this slide, you can see that we've included several of the different types of Platts assessments that we have. And even when looking at both the methane collection price and the renewable energy collection price, you can see that prices have really skyrocketed since we first launched these assessments back in August. This has been really illustrative across different types of carbon credits, and particularly illustrative in nature-based solutions, which have really seen a sharp increase in prices since Platts began assessing them back in June. They have moved from about $4 per metric ton of carbon dioxide equivalent all the way up to close to $13 per metric ton of carbon dioxide equivalent. So there's been a really big shift in the types of credits that people are looking for. But overall, the increase in demand that has led to a sharp increase in prices has been characterized across all different types of voluntary carbon credits. What Platts is actually doing is we have moved away from this idea of being able to create one singular price of voluntary carbon. It's very difficult if you're trying to look at, and it sort of strips it of all meaning, if you're trying to draw a single price of carbon between a 30 cent per metric ton of carbon dioxide equivalent price and a $500 per, where do you find the equilibrium in that? So what we have done is we've introduced individual spot market assessments for different types of voluntary carbon credits. On one hand, we have the Platts CEC, which I mentioned earlier, which reflects CORSIA eligible credits. And we also have the Platts CNC, which reflects nature-based carbon credits. These are all individually assessed voluntary carbon credit assessments, which we publish each day. We also publish individual assessments for different types of voluntary carbon credit projects, including renewable energy, methane collection, household devices. So these are things like the cook stoves projects mentioned earlier. Nature-based avoidance. So this is specifically avoided deforestation. We make a distinction between nature-based projects that are both avoidance-based types of credits and removals-based types of credits. And we also assess industrial pollutants. And then together, these can form a basket assessment. It's called the Platts CAC, which reflects avoidance-based carbon credits. We also publish daily spot market assessments for removals-based credits of both a tech-based carbon capture, so things like carbon capture and storage, and direct air capture, which are currently a very small proportion of the overall voluntary carbon market, but are expected to play a much more significant role in the coming years. And then we also publish a separate price for natural carbon capture credits, which are things like reforestation and afforestation, which are very distinct and separate from a lot of the avoidance-based projects that you see, particularly in terms of avoided deforestation. Together, the most competitively priced of these will be the Platts CRC, so the removal space credit assessment each and every day. We also publish in partnership with Viridios, which is an AI company, 6 separate AI indices which look at different types of sustainable development baskets in order to bring transparency to a part of the market that has historically created quite a lot of questions around how different prices, how different attributes of different projects can affect prices. So if you have, for example, an avoided deforestation project that only has biodiversity objectives attached to it, that will often trade at a discount relative to a voluntary carbon credit price that carries those biodiversity objectives in addition to other things as well. So we are always very happy to talk about this in more detail, but the objective with this is to capture a clear understanding and take a very clear snapshot picture of individual types of carbon credit projects without overgeneralizing this into a single price that strips it of all meaning. So with that, we can answer more of these questions moving forward into the next, as part of the question and answer session. But for now, I will leave it at that. Thank you very much.
Thank you, Paula. My name is Zeflo Kunwala. I'm an energy market specialist here at Bloomberg, and I'd like to give you some perspective on the trading activity in this space, historical as well as today. So going back in time, you can see the EU ETS, which was launched in the 2005 timeframe. Initially, in phase 1, we had grandfathered allocations. So essentially, you reached a situation where there was a lot more supply than demand. The actual allowances used were less than the allocated amounts, and you saw this situation where prices literally went to zero. And then came along phase 2, when 90% of the allowances were allocated for free. And as we progress forward, we see that the inclusion of aviation added 10 to 12 million tons of CO2 demand. This was in the beginning of 2012. And then we also had the activation of the EU ETS registry, which led to the migration of 30,000 different EU ETS emission trading system accounts over from various national registries. Then at the end of phase 2, this is also the start of the first commitment of the Kyoto Protocol. So phase 3 had 57% auction and 43% free. Manufacturing industry allowances shrank from about 80% free in 2013 to about 30% free in 2020. For power generators, no more free allowances, in principle, with exceptions for some member states. Airlines continue to receive a large majority of the allowances free from 2013 to 20. Now, from 20 to 30, we have the third phase of the ETS trading period. We've included carbon dioxide emissions from the maritime sector, which also adds a big chunk of CO2 to this mix. And so on Bloomberg, what we do is try to give you a transparent pricing on all of these instruments that are actively traded. So for the East Coast, you can see the forward curves. This is 4 different vintages. So you can see vintage 21 versus 22. So RGGI, that's the East Coast Regional Greenhouse Gas Initiative. CCA is California. And you can see the 21 and 22 vintages and the forward curves there. CBL Expansive is a spot exchange for trading offsets. So the stuff on the left of the screen is allowances. The CBL, they've also made a deal with the CME to list forwards on these. LCFS, this is the California Low Carbon Fuel Standard. So this is related more to transportation fuels. And California, being net short, has essentially created a demand for road fuels. The CCA is tied to stationary facilities, so power plants, refineries, manufacturing facilities, and so on. So we try to give you pricing visibility. Our fair value pricing will reflect these prices. And in terms of what is driving these price moves, I mean, we've seen prices go straight up lately, and it seems like there's a good correlation between power prices and emissions prices. And if you've seen the situation in Europe and Asia lately, there has been a big spike in gas prices and coal prices. So power generation is pulling more gas and coal and hydrocarbon demand. That is also creating a bigger demand for allowances to trade. So we offer you different tools to be able to run analytics to see what is driving demand going forward. In addition to that, we also have commodity price forecasts from various banks. So you can see the banks are actually forecasting a lower price than the forward price going forward. So maybe the sell side thinks there's some mean reversion likely over here in the short term. We are also seeing a lot of retail participation in this space. So this is the carbon ETF. And if you look at the green line, that's the price of the ETF. You can see how it's gone up in value. But if you look at the shares outstanding, which is this white area over here, you can see that there's been a big increase in the shares outstanding from the beginning of the year. So we're seeing more retail participation, and even funds are finding it easier to trade the ETF versus trade the individual futures contracts. And all of this is complemented by our research. You've heard Kyle discuss BNEF's research, but we also have our BI analysts who cover carbon in detail, the policy side, as well as the market side. And Paula had briefly mentioned this, and in the offset space, the registries are the one who are essentially recording these projects, and Vera, Gold Standard, etc. These are some of the bigger ones. And if you need more details on these, we're happy to discuss with you how offsets are registered and how they're tracked and so on. So that is a brief overview of the market activity in this space. Next, I'm going to hand it back to Kyle for our Q&A portion. Thank you.
Perfect. Thanks, Zeph. Hope everyone enjoyed the presentation today. So like Zeph mentioned, we're now going to transition to our Q&A. But just to let you guys know, if anyone wants to learn more about Platts and Bloomberg and our offering in the carbon space, we've actually put up a poll question in the slide window. So feel free to go ahead and answer that if you are interested in following up with us or having us follow up with you. So let's dive into Q&A now. And we've gotten quite a few questions from people in the audience. And I think one question that a bunch of people in some way, shape, or form have been asking, and I think it's an important one for us to discuss, is what happens if you make a carbon offset market more like a traditional commodity market, right? Zeph, you are a commodity specialist. Paula, you were talking quite a bit about the different offerings that you all have at S&P Platts. Let's talk a little bit more about this. Do you guys have any kind of points for or against making the carbon offset market more commoditized?
I can start off with that, actually, if that's okay. So one of the things that I think is really interesting about this is that the way that we see this actually is that it's already trading like a commodity market. Oftentimes when people talk about sort of emissions, I think, and historically the way that people look at emissions markets, particularly the voluntary carbon markets, they kind of view them separate from the commodity space. And I think one of the lessons that we've drawn in sort of the assessments that we've built, and the reason why we built them this way, is because this already starts to look like a commodity market. But we actually don't see it looking necessarily like a commodity market the way you see in power or the way you see in gas, where everything looks like everything else. And the reason is because part of what makes the voluntary carbon markets rich and part of what attracts buyers to them them are the different attributes of individual projects. And so when you start to kind of create a system that only looks at the commoditized side of it, you can really strip the projects of the pieces that make them meaningful, and can also kind of drive that market to the lowest common denominator, which is fine from a climate action standpoint, but you would lose all of the kind of additional rich sustainable development objectives that are attached to that. That said, I think there's very much a space for that within this market. So you do have things like Zeph talked a bit about the expansive CBL contract, which is the GEO and the NGO. We are actually partnered with them as well to work on kind of looking at building that out as well, in addition with CME. And that is, an instrument that trades very well and very liquidly because of that kind of level of commoditization. But you also see demand for kind of a more bespoke approach to prices, the way that you do in diesel or crude, where all of these different attributes that make up a cargo actually matter and impact the price. And so you don't necessarily want to take those out because they have a pretty substantial impact on value over time.
Yeah, thanks, Paul. I think that's a really good point, right? And it does kind of encapsulate the divide you see right now, right? So there are all these groups that at one side of this want to make this more like a standard commodity, right? I mean, one group that is pushing a lot for this and to create a more liquid market in this regard is the task force on scaling voluntary carbon markets. But then on the other side of the spectrum, like you said, there's all these companies that really do value those co-benefits that come with a project, and being able to actually, customize and select the project that you're purchasing carbon offsets from. So it seems like what you guys have at Platts is kind of a nice hybrid between the two, where there is some commoditized element to it, but customers still do get that kind of that choice to determine, do I want to focus more on reforestation with co-benefits, or do I want to look more at technology-based removal? So that does seem like a good hybrid kind of area for this. Zeph, do you have any thoughts on this as well?
Sure. So, right now for the offset space, there's a big over-the-counter market that's served by many different brokers. As you get more exchange-listed instruments that are increasingly standardized, there is reason to believe liquidity will go up. Also, even the energy sector, they're seeing a lot of opportunity. It's not just a cost anymore. It's a way to make money, to effectively deploy technologies that result in the removal of carbon. And energy companies have, the intellectual power and the expertise to guide this transformation. So they're increasingly looking at it. So from what we see anecdotally in talking to our customers, fund activity is still relatively small. Commercial activity is about an order of magnitude higher. And the commercial space includes the merchants. The merchants are getting very active in this space. And as these standardize increasingly and more instruments are available to be able to easily trade in and out of these things, and liquidity is another key. Up to until this year, there wasn't that much liquidity. You put on these positions, you were pretty much wearing them till the end of the season kind of thing. Now you're able to get in and out of these positions, so you're able to trade these better. So I think we're seeing these markets mature like we have in many other markets, and it'll standardize. It's different yet similar.
Yeah, and Zeph, you talked a little bit about making money from this, right? Let's dive a little bit more into that. So who stands to benefit the most from a more standardized or commoditized carbon market, right? Is it traders? Is it corporations, right? I think there's some benefits and upside for those types of companies as well. Is it investors? What do you guys think?
I mean, the short answer is all of the above. And at different points in the commodity cycle and the deployment cycle, this obviously has an effect on other fuel prices. So there's a strong correlation between coal and gas prices and carbon pricing. So I think people are increasingly finding the key factors that drive these. And that is also creating more opportunity as you're able to understand this and you're predictably able to track the underlying reasons why these markets are moving. And of course, regulation is definitely a key part of it, but the commercial side of it should increasingly play a bigger role.
I think one of the things that's going to be very interesting seeing this develop is sort of the importance that improved transparency will have in the development and development of an investment in voluntary carbon credit projects as well. We talk a lot about kind of what role traders can play in this space, and obviously it's a large one, but it's pretty key that the whole objective here is to kind of manage emissions and the upstream as well. So one of the real strong potentials for voluntary carbon is a way to direct that investment to effective projects that don't just have that kind of single attribute around emissions management, but also have other ESG objectives, particularly around sort of sustainable development, particularly for a lot of these projects, which are really important. And for many years, a lot of project developers haven't had that level of transparency because they haven't been responsible for being able to transact their projects to their credits to the final buyer. Whereas now, if you have this kind of level of commoditization, whether it's a single instrument or whether it's something like a benchmark, you can actually start to bring that additional level of transparency, which will help that investment and really improve it probably pretty quickly down the line, which I think is going to be pretty important going forward.
Yeah, I mean, that co-benefits element is of course very important, and it's going to become more important as well, right? As we start to look more at something like nature-based solutions, right? So you think about mitigating climate risk from restoring forests. You think about biodiversity, which is a big factor in some of the carbon offsets that you all are looking at. So yeah, I completely agree with that. And the last one that I would just bring up for everyone in the audience is, I think offsets also present an opportunity for product distinguishment from a corporation, right? So we started to see kind of early signs with this in the fossil fuel sector. So Occidental Petroleum went ahead and started marketing carbon neutral crude, where they're going ahead and purchasing carbon offsets to basically neutralize any emissions that they're making from producing that crude. And Cheniere is looking at something very similar for carbon neutral LNG. It's very likely we're going to start to see offsets play a much more prominent role in the production of green steel and green aluminum, but also things like marketing a carbon-free cloud from the tech companies, IoT, all these types of kind of product distinguishments that'll unlock new customers for companies as well. So I think that's kind of an exciting opportunity in the carbon markets that most people don't think of from the corporate side, right? I think a lot of the thought is, more expensive offsets. It means that it's harder for these companies to achieve their goals, and they might focus more on reducing gross emissions. But there's absolutely some business opportunities here as well. Just gonna move on now. We've gotten also a lot of questions to dive a little bit deeper into who is buying carbon offsets today. And I actually think that is a nice segue from the points that I was just talking about. Paula, Zeph, what sectors are we seeing right now that are, I guess, the most exposed to rising carbon prices? But moving forward, where do we see most of the offset demand coming from by sector?
So I can start that off for now. I mean, we're really seeing demand from lots of sectors. I think one of the things that we say is that, like, carbon, of all of the commodities that Platts actually looks at, carbon is the one that kind of sits in the middle of all of them. We have conversations with metals companies, cement companies, oil and gas companies, which is our more traditional wheelhouse, petrochemicals companies, airlines, tech company. I mean, it's really all over in terms of the people who are the most interested in it. In terms of the greatest exposure to how this is likely to sort of impact if prices are increase, which it seems likely they will. We don't make predictions on the pricing desk. But it does seem like that is kind of really the trend where things are expected to go for the long term. I think the exposure is for anyone who's really committed to that kind of carbon neutral objective, particularly in high carbon industries. You're going to need to start looking at carbon intensity and making those emission savings more broadly, because there simply are not enough carbon credits out there in that space to manage everyone's emissions based on everyone's objectives, even as these markets continue to develop and more projects and credits are issued. So as a result of that, I mean, the price of carbon as it increases is going to be something that everyone in every industry is really going to have to start to reckon with, I think, a lot more than they have, at least if they plan on actually meeting the carbon neutral and carbon credit objectives that they've set out.
And we increasingly saw the bigger companies take the lead in this, the bigger tech companies, the bigger energy companies, especially the European majors and so on. Now we find the demand is spreading to the smaller companies. Like virtually every company is forced to look at these, and they've added resources, they've added people, they've added teams. They've added maybe a chief sustainability officer, and also having the taxonomy to be able to properly track the emissions on an industry-specific basis. As that has evolved, that has also added transparency to this market, and it's just sort of helped level the playing field a bit.
Yeah, so I think the big takeaway here is that there's no sector that won't start to really, start looking considerably into the carbon markets, which is an important point. So the next area I want to move into, and again, getting a lot of questions on this, is around regulation. And Zeph, you brought up regulation during your presentation and during the Q&A. And then Paula, of course, you talked about this from the Article 6 standpoint. Maybe we can start with what happens with these registries and standardization of the market. What do you guys expect for, especially voluntary markets, in terms of regulation moving forward? Should we expect something like that? Should we expect the market to continue to operate as it does today from that regard? What are your thoughts?
I think from the voluntary side, certainly the way that corporate commitments are kind of creating demand within the voluntary carbon market is likely to continue independent upon what additional regulation you're likely to see. The important thing around Article 6, which is going to be very interesting, is how the market actually develops in conjunction with these sort of correspondent adjustment sort of spaces. And that's more of a regulatory sort of thing. And it's going to have a really big impact on a lot of what credits are available in the market, right? So if you are a carbon credit project host and you choose to use that for your correspondent adjustment and you don't release that to the market, then that's going to have a big impact on overall supply. It's going to have a big impact on what corporates can buy. It has a big impact on what other governments are likely to be able to buy. But then also at the same time, if you just release those carbon credits without that corresponding adjustment potentially, then, does that carbon credit, because it isn't correspondingly adjusted, will it have the same cachet as a credit that does? And so I think one of the things that you're going to see is this potential integration between the two markets. So, like a voluntary market that looks at credits that are correspondingly adjusted and a voluntary market that looks at credits that are not correspondingly adjusted. And you might see kind of a split between those two things, but it's almost too soon to tell. I mean, one of the really interesting things about the voluntary carbon markets is anyone on this webinar, I would think, certainly myself, wouldn't have necessarily predicted that we'd be in this place now when, at the start of this year. Things are just moving very, very rapidly and are evolving very quickly here. And it's difficult to kind of claim that something will look one way in 6 months, let alone a year and a half, let alone 5 years from now, because things are just moving very, very rapidly in this space. And there's still a lot of things that really need to be worked out before we know a real solid answer one way or the other about that.
Yeah, and I think some big news that we saw a couple weeks ago as well, right, was the net zero framework that was created by the Science Based Targets Initiative, right, and the impact that could potentially have on this market as well. So for those of you that aren't familiar, the Science Based Targets Initiative is basically the largest group of standardized corporate emission reductions goals. And until a few weeks ago, most of these companies would set a science-based target that would basically bring emissions down on a Paris-aligned trajectory by 2030 or 2035 or around that time frame. And SVTI recently kind of took those targets a step further and created a framework for net zero for corporations as well as part of this initiative. And one of the key things that they're saying as part of SVTI is, in regards to offsets, you can only purchase offsets once you've reduced your gross emissions on a Paris-aligned trajectory. So basically anything residual under that Paris trajectory is fair game for offsets. But then they've taken it a step further and they've said you can only use removal offsets to go ahead and achieve net zero in that specific target year. So Paula, Zeph, I think this is also really important. It's not regulation in the way you traditionally think about it, right? But it could strongly dictate where demand comes from in this market and where future supply comes from, So I wanted to get both of your thoughts on this area as well.
Sure. Paula, go ahead.
Are you sure? I can go second this time.
No, please go ahead.
I think the SVTI is fascinating because it's really put this focus on removals. And the reality is that within the voluntary carbon credit markets right now, removals are a very small proportion of what's available. The vast majority of credits that are out there would technically be avoidance. And it kind of depends on how you classify removals because, depending on who you're talking to, nature-based avoided deforestation is a removal, but we don't view it that way because it is sort of like the standard status quo. So, it's not really a removal, it's more of an avoided emission. So it's kind of interesting to see how that huge focus on removals is likely to affect demand for specifically removal-based projects because there just aren't very many of them at the moment. It's expected to become a bigger part of the market, particularly as tech-based carbon capture projects are scaled up and become more viable in the long run. But that's sort of one of those areas that, again, is sort of looking into this future that people expect to go a certain way, but isn't necessarily the same as it actually happening or being available now. And so this focus on removals, perhaps we sort of see a good cause for that in terms of reaching net zero. But if you're only focusing on removals at the moment, there's no way that you can actually meet those objectives with only removals-based credits. There just simply are not enough out there at the moment.
Yeah, I agree with Paula. The removal space is very interesting, and there are some very exciting new technologies on the horizon. And as Paula mentioned, some of these removal technologies right now might cost more like $500 a ton, but there are offsets that are offered for very little. So it's a bit like the wild, wild west out there. But you also need the capital to fund the innovation of these removal technologies, and I think that's where it gets interesting. So if you look at sustainable debt, sort of step back from just the carbon trading and look across asset classes and see how sustainable debt is funding some of these greener projects, and also how, for example, SPACs are funding some of these emerging technologies. There is capital available to spur innovation, and I would think some level of innovation to have more efficient removal technologies is probably the key in the future.
Yeah, I mean, I think you've kind of both provided interesting points, right? I mean, on one end of the spectrum, the market is not prepared. The voluntary carbon market, at least, is not prepared for removals only. Because to Paula's point, you don't have enough technology-based removal right now. I think there's maybe one or two direct air capture projects that are actually fully commissioned and functioning around the world today. So putting that much weight on a technology that is so nascent is also complicated. But to Zeph's point, right? You need to start to see investment flowing into those technologies if you ever want them to scale up and we ever want to see a removals only market, right? So there's kind of a bit of a carrot or the stick here, right? Because if you get companies to start emphasizing reducing gross emissions more and focusing more on removals, that's going to catalyze more investment into this market moving forward. But yeah, Paul, I would completely agree with you that the current market as it's designed today, there's just not enough removal supply out there. And a lot of the regulations that are coming out now are going to actually take a huge hit for the avoidance sector as well, right? So Gold Standard and Verra, the two biggest voluntary carbon registries, moving forward, they only will allow offsets to be generated from clean energy projects in least developed countries. But if you look at where all the energy generation supply is coming from today, it's coming from coal to gas projects in China, large hydro projects in India, and projects in the United States as well that wouldn't classify or qualify for these new types of things. So I feel like the supply, the mix of supply in the offset market is kind of going to be flipped on its head very soon. It's going to change very significantly, which will be very interesting to follow. Perfect. So we're kind of running down to the wire here. I wanted to kind of throw up one more lob question for you all. And Paul, I know you said you guys didn't want to make any broader predictions on specifically where prices are going or anything like that. But I guess if you were to kind of give the audience today kind of an indication of whether you think prices are going to go up or down a lot or a little, do both of you have any thoughts there? And you don't need to do specific numbers.
So the reason why I said I didn't want to do any predictions is we have an analytics division that does that. I'm from the pricing side, so we look at spot markets typically. But what I will say is that if you look at basic economics, we're looking at the increase in demand relative to the increase in supply. There's a lot more demand coming in than there is necessarily supply. And whether or not that's demand resulting in actual retirements is one thing, and is a sort of whole separate conversation we can get into. But in general, you're seeing more demand come in than supply. And typically what that means is you're going to see a sharper increase in prices. We've already seen that this year. Like I said, it's up 800% on our most competitively priced credits. And that's just since January. It tends to go through these periods where it'll slow down, and then you'll see another massive surge in prices, particularly for credit types that are really high in demand, like nature-based credits were throughout much of the autumn, the late summer and autumn. You just saw this massive increase in demand, and there just weren't as many credits available, particularly of specific vintages, the ones that people really want. And so these are things that are of newer vintages. There are still a lot of older credits that are floating around in the market that are trading at much lower prices, but people don't necessarily want those credits. They want the newer credits. And that's where you start to see, those things kind of sell out quite quickly. And you see much higher prices for those sorts of vintages than you do for others.
From my standpoint, I would expect volatility to continue to increase. In terms of making price predictions, that's very hard. You're seeing some prices that have gone parabolic. It's hard to extrapolate that and keep expecting that to continue without some sort of mean reversion. But I feel that a shift to a renewable power generation mix adds to volatility. And we've seen that with wind power in Europe this year, for example. It came in under the stilling effect. If we shift to a bigger renewable balance, and the renewables are not there when they're needed, at the moment when they're needed, and you start driving more commodity price volatility just through less reliable systemic power, then I can see increased volatility in this space. So I think that is something that will create a lot of trading opportunities. These are instruments that move a lot. As the liquidity improves, I would think market interest will continue to grow.
Perfect. No, I love that you changed it up there, Zeph, and you didn't just say prices are going to rise. That's
Everyone
good.
says that, right? You have to look beyond that. I mean, that's kind of the crowded view. Everyone expects it to go straight up, and the ETFs are a good indication of that.
Yeah. I mean, I guess the one thing I would say here, right, is that if you allow the voluntary carbon market to operate in the way that it currently does, and supply is not restricted to removals, and it can come from any sector anywhere in the world, you might not necessarily see those increases in prices, right? So there's I think that the main answer here is there's a lot of uncertainty, and the way certain things break over the next couple of months is going to be a huge determinant in this. Perfect. Well, that concludes the webinar today. Paula, Zeph, thanks so much for your time. Thank you everyone for joining today, and please, yes, if you're interested in hearing more about Bloomberg and Platts' carbon offering, please feel free to respond to the poll, and we'll get in touch. Thanks everyone for your time.